Practice revenues, costs, assets, and liabilities. The objectives of this lesson is that by the end of the lesson, you should be able to discuss the costs in running a financial planning practice. You're going to be able to explain the ways to determine what to charge to meet your revenue goals. You're going to understand the difference between recurring and non-recurring revenue, and you're going to identify some funding opportunities. So the first thing that you need to do, no matter what kind of practice you decide to do, is that you're going to need to maintain your license and your designations. So there's some regulatory costs. That would include your errors and omission insurance and continuing education and your renewal fees and your compliance and the registration and oversight. Whether you outsource that or you have a firm provide it, you're still charged for it. And then of course your state registration for securities, and if you have insurance licenses, then you need to pay for those too. And that's for each state that you're going to have some registrations to do. And then any exams or things that you need to do to keep your license in good standing. And then memberships, like for example, the Financial Planning Association. Now, technology. You are going to need to pay for the technology, whether it's to use the technology provided by the firm to which you have joined, or if you're starting your own firm. Remember that you need to have not only the computer, but the operating system, and it should have calendar in it, and an email, and word processing, and you're going to need IT support when the systems fail. So whether you outsource that or you have a dedicated person on staff, that always happens, and you're going to need to have somebody available to help you. Phone systems, you want to make sure that those are in place, that you have a dedicated line, that your staff has the ability to pick up your line if you're not there and you're with a client. So those kind of systems you need to factor in. And then of course your office machines, whether it's scanners or copiers or printers, and a workstation for each person, fax machines. So you need to think about those as well. Now, software subscriptions are also important. Your customer relationship manager software, your trading platforms if you manage assets, and that would include rebalancing software and something to generate the reports so that the clients can see how they're doing. If you're going to do financial planning, then there's financial planning software to consider. A website, you need a website host. Clients often Google you when they're introduced to you, so you need to have some sort of media presence. And then, of course, accounting and payroll, somebody to keep track of the money and make sure that your staff is compensated, that you're compensated, that you're paying your taxes, all of those things. So those all need to be considered. Now, the office itself is another expense. Whether you rent it or you own it, you need to insure it, not only the building itself, but you have to think about what happens if somebody hurts themselves on the premises. Make sure you have the proper insurance in place. You're going to need furnishings, not only for yourself and other advisors, but your client's comfort, your conference room. If you're going to do seminars there or something, you're going to need seating for that. So you need to plan ahead for that as well. You'll want a separate bank account, and maybe your checking or whatever you use to manage the expenses of your firm, and there'll be some charges for that. And then parking, factor that in. You're going to want to not have your staff have to pay to park in the building. And do you want your clients to pay to park? That's a consideration. So those are things you have to budget. Advisor salaries. Now, this is not only the owner, but any team members that you hire that are licensed, and you have to think about what you want to make yourself and how much to pay your team members and what that means. You need to charge clients in order to support these salaries. And then of course you have to factor in profit. So in other words, you can't maintain a business without that profit considered a very, very important part because something could change in the way that the revenues come in. Advisors will want raises if you want to retain them. All kinds of things will come up that if you have not put a healthy profit margin in there, you're going to put your business in jeopardy. Now, you want to position your practice for growth, again, to support those salaries we just talked about. So think about marketing and your web presence and branding yourself on all of the client deliverables, whether it's your business cards and stationery, any social media things that you participate in, or newsletters and postage, and you're going to want to go to conferences. You've got travel expenses associated with that. You want to do some client appreciation events. So factor that into your budget. Now, on the revenue side, we have both recurring and non-recurring revenue. Recurring revenue is predictable. In other words, you're going to know that if somebody has signed an agreement that you're going to charge them a certain percentage, say 1%, as their assets under management fee, that you're going to collect that fee. Now, non-recurring is a one-time payout. Maybe you have an insurance settlement because the water leaked in your building and the insurance paid off, or you had a flat fee for speaking for a one-time engagement, or maybe you sold an asset that was priced at just one compensation at the point of sale and there are no trails. Those are non-recurring, so you need to differentiate where that revenue is coming from so you know what you can count on and what was one-time revenue. Now, assets, don't forget about the talents and the personal charisma of the advisor. A lot of the value of the business is that advisor. You attracted those people to you. So that's an asset to the firm. The revenue that advisor produces is an asset. You've got some staff that's indispensable. They're so efficient. They do the job of two people. Your clients love them. That's an asset. You've got your loyal customers. So when somebody's looking at the value of your business, gosh, you have this great customer base. And then centers of influence. You may work with a really great CPA, an attorney, a realtor, a banker, all of these things that are closely associated with the firm and have relationships with the firm are something that help maintain your value. Liabilities are your debts. They're the leases, they're any accounts payable, and of course the wages. So if you're looking to keep an eye on how your numbers are doing, you might want to put together an income statement similar to this, where you look at your revenue, you subtract the direct expenses that we talked about, then you're going to look at the gross profit and determine how much your gross profit is. Then you're going to subtract your overhead for your staff and your rent and your software and your IT. And so now we've compensated the advisors, we've done the overhead, and then you're going to want to make sure you have an operating profit of at least 25% to show that your business is healthy. Now, the numbers matter because you use this information to determine when to add advisors, lower minimum account size, and increase fees. And having that healthy profit margin protects your firm. So if the assets under management, the amount you're charging has remained the same, but the value of the assets have gone down, you need that profit margin to carry you over. There's industry trends. Maybe there's some fee compression where you need to charge a little less. Or maybe there's a fund family or product payouts or something that changes the way that they compensate you. So think about an emergency fund for your practice. That's what that profit margin is going to do. So knowing your costs is very important in order to plan the amount of revenue you need to support your business. There's a few different ways that you can price your practice. Pricing by cost of time. You might say, okay, I'm going to do 10 hours per client per year, and I am worth $200 an hour. So that means you need to charge at least $2,000 a year for your services for that particular client in order to make this this price of the revenue that you're counting on make sense. Now, other advisors price by what they know their clients can pay, and these are typically for high net worth clients where they just take a percentage of their annual income, or they also do this for very small clients where they know they can't really afford to pay what they should compared to their other model, but they might say, well, you're going to have some money later, which is why I've taken you on. So how about if I just take a small percentage of your income and that's your retainer? So that's similar to how your assets under management works for the funds under management, but you might price it by what the client can afford. And so again, you have to determine the amount per client and adjust the number of clients to meet that revenue goal. Now, knowing what your clients can pay, there's value-based pricing as well. You can do this when you have a particular specialty and you maybe have a higher hourly rate and you want to the clients perceive that value is very worthwhile, and so they're willing to pay you a high hourly rate. But the downside of that, of course, is that they have to see you do this in a short amount of time, or they might not perceive the value is worth it. If it takes you a very long time to do it, so there's many hours involved in what it is you're asked to do, that diminishes a little bit the value. So often this is something where you can do it in a small chunk, you can do it fairly quickly, and you're charging a little bit more because of the value you provide. Now, some of the ways to bridge the gap when you're ready to begin is there's some small business loans. You might find a partner that can help you share those expenses. And you factor in the profit revenue in order to know what you can afford to get started. So some of these things will help you get your business off the ground. And again, keeping track of these numbers are going to really help you know what you need to do as you plan your business for the coming year. So in summary, you learned about the costs of running a practice, the ways costs lead you to the ideal size and fee, and the ways to fund your practice.